Okay, let's get started. Good morning, good afternoon, and good evening to those of you joining, and welcome to the third installment of our Fall 2022 Global Economic Governance Book Talk series, hosted by the Boston University Global Development Policy Center. The Boston University Global Development Policy Center is a university-wide research center that works to advance policy-oriented research for financial stability, human well-being, and environmental sustainability across the globe. My name is Rishikesh Ramandari, Assistant Director of the Global Economic Governance Initiative at the GDP Center. So the big question that we're really talking about today is how can money be used to build a more equitable and sustainable society? Money defines our present and will shape our future. Every investment decision made adds a chapter to the story of what the world looks like. Although the idea of mission-based finance has been around for decades, there is a gap between organizations' stated intention to do good and meaningful impact. Still, some are succeeding. Just Money, Mission-Driven Banks and the Future of Finance is a new book from Katrin Kaufer and Lillian Steponaitis. This book takes readers on a global tour of financial institutions that use finance as a force for good. Katrin and Lily visit a bank in Europe that bases its business model on full transparency, a credit union in Canada that designed an alternative to payday lending for its community and microfinance institutions in El Salvador, and Bangladesh that provides financing to small business clients who do not have access to the mainstream banking system. They discuss what it takes to build and operate a mission-based business, whether the just banking model is scalable in the face of systemic barriers, and how to assess impact effectively. They introduce the logic of ecosystem finance, in which business decisions align with societal needs. And in doing so, requires more than adding impact indicators. It requires developing a new business model itself. And so with Just Money, Kaufer and Steponaitis are demonstrating that money, if used intentionally and equitably, can be just money, a tool that serves nature, human development, and social justice. So Dr. Katrin Kaufer is program director at the MIT Community Innovators Lab, MIT CoLab, in MIT's Department of Urban Studies, and planning and executive director of the Presencing Institute. Her work includes a research focus on leadership, organizational change, values-based banking, as well as on participatory action research. Lillian Steponaitis is the Racial Wealth Gap Initiative Coordinator at the Center for Community Self-Help, called Self-Help in Oakland, California, and formerly a postgraduate fellow at the MIT CoLab also. Her work focuses on the role financial institutions can play in creating more just, equitable, and democratic economies. So just a few logistics before we get started, before we open the discussion. I want to mention that this webinar is being live streamed on YouTube, so a recording is immediately accessible. Please use the Q&A box located in your Zoom menu to ask questions. Please also give your name and affiliation so that we can call on you. We will take questions after our initial discussion, but feel free to enter your questions at any time. We'll have Katrin and Lily do a brief introduction, and then we'll move to an informal conversation on this book before opening up the Q&A. So Katrin, please take it away. You have around 7 minutes.
Thank you so much, Rishi, and welcome to everybody. It's wonderful that you joined this session. So Lily and I, even before the financial crisis hit, felt that our research focus should really be on finance. We are faced with polio crisis, and we will not be able to address the challenges we are confronted with not transforming the financial system. So we felt that finding a leverage point for moving the financial system in a different way is essential for finding solutions to the enormous challenges that we are confronted with today. So we started to innovators at the margin of the financial system. So we all know that innovation starts at the margin. So the new emerges not from the center, but from the margin. And we thought, how do financial institutions that use finance as a tool for change operate? And we began researching them and working with them. We were also involved in founding an alliance of these banks, which is called the Global Alliance for Banking on Values, and has over 70 members today. And Lillian and I launched an online program at MIT MOOC with the same title, Just Money, where we then featured all these best practices. And the book is basically a result of this. Before I lead over to Lily, maybe just two core ideas here. So what's really driving us is the recognition that finance, as Rishi said, writes the story of our future. The allocation of capital is the strongest determinant of where we are collectively going. So who gets a loan, who doesn't, really determines how our future is going to look like. And the idea that finance needs transformation or it's as old as the monetary system itself. So you see in all monotheistic religions, for example, suggestions for how to restrict the monetary system. The purpose of the monetary system is to facilitate financial transactions for our economic system. But the monetary system in our economic system has become so strong that the economy is serving the financial system. So we thought, let's take a look into how financial institutions operate that do exactly the opposite, that use finance as a tool for change. And in 2 or 3 minutes, I will give you a quick glimpse into some examples of how they operate. So we call this impact. We found different impact strategies in the banks we work with. So impact strategy number 1 is what you see now in every bank, which are isolated social and green projects. We don't call that just money. So Bank of America, every big bank today has some isolated projects. So the difference between that and the financial institutions that we looked into are that the idea of using finance as a tool of change becomes core to the business model. And that has implications. It has implications for, what kind of products these financial institutions offer and how they innovate. So for example, Rishi, you mentioned the banks we worked with in Europe. So we work with over 70 banks, but a few of them in Europe, for example, use 100% transparency in their business loan. The core idea is to show what your money finances when you deposit it at the bank. So for example, they offer an app on your phone, you visit a city, Madrid, and you see what your bank is actually financing. And the purpose of that is, everything that this bank is financing is social and green. So every client that's on this map has a focus on a social and green economy. Another example, you mentioned Van City, the largest credit union in Canada. They developed a product innovation, an alternative to payday lending, where on your app you can immediately get up to 1,500 Canadian dollars and get out of your payday lending. So this level 2 of financial strategies that we found basically describes innovations from this perspective of how do we improve the well-being of our customers. And then we found a third level, which is a recognition that most of the banks are pretty small. So these are credit union, community banks. And because they are small, they don't have a large volume. So their change strategy is not through volume, but through identifying key innovators in the field. So here, another example of from Europe, GLS Bank. There are a lot of tourist boats on the river that's in Berlin, the river Spree. And in order to change this market of highly pollutive tourist industry, they financed solar, the first provider of solar ships, a lead innovator in this field, and then with that attempting to change the market. So that's strategy 3. How can we change a market? And then the more recent development that we've seen in a lot of the bank we work with, we came to describe as ecosystem innovation. What does that mean? So Lily conducted all of this research in Mongolia, the coldest capital of the world, in Ulaanbaatar. A bank we work with, Hasbank, developed a loan product where they moved away from a transactional relationship to a multi-stakeholder relationship. So these white huts that you see across the city are girts, and they're very poorly heated. So these inhabitants are not able to afford an upgrade of the heating system. So what the bank did is to put multi-stakeholders around the table, a network of producers for more energy efficient heating, a foundation that sold CO2 emission certificates, and then they developed an affordable loan. And in this constellation, they were able to really shift the system and to reduce pollution in Ulaanbaatar by 40%. And we see this kind of ecosystem collaboration more and more. So maybe, Lily, over to you. Yeah.
Thank you, Katrin, and thanks to everyone for having us. I'd be excited to get into the conversation. I think a lot of those ideas are worth diving into around the sort of the 4 levels in particular. So Rishi, I'll pass it to you.
Yeah, great. Thank you. So let me ask my first question to you then. So, I was just at the COP, and there's a lot of talk about scaling, right? Then, the very, very big, important need to make sure we have finance at scale. So could you talk a little bit about this scale issue and sort of, speak to what role can mission-driven financial institutions really play in bringing financial innovations to scale?
Yeah, so I think one joke that Katrin and I have had over the years is that if, a big bank like Bank of America decides to recycle, they might have sort of more environmental impact than, all of the work that sort of one of these small mission-driven banks does. But, this really goes to the sort of level 3 and the level 4 sort of approach to change and approach to innovation that Katrin was just speaking to, where the direct impact that any given institution can have is sort of relatively small in the grand scheme of the changes that we're trying to make. They can act as sort of systems innovators, so to find sort of the key players who can shift a system, and they can also act as sort of demonstration projects. So, banking is a very conservative industry. They like to see other people doing things before they do them, right? Because there is all sorts of risk. There's financial risk, there's regulatory risk, there's moves that they have to consider really carefully before they do something. So they will often larger banks, for example, will often look to these smaller institutions who they engage with and say, okay, oh, I see they did this. This is how they did this. This is how they proved the risk. So I work currently in the CDFI space. So that's community development financial institutions, which are which are essentially community banks and credit unions across the US serving previously redlined communities. And we find this a lot in our work and it is our sort of key strategy. One of our key strategies is to say, okay, let us test the risk of this. Let us prove that this is possible. Let us show you how you can do it. And then we advocate. So once we've sort of done that, we then advocate to the larger institutions who we have relationships and say, or to Fannie Mae and Freddie Mac and other sort of government institutions and say, look, this is how we can do this. We challenge you to, to take this on as well. So that's really one of the key mechanisms to scale is that sort of almost like proof of concept in these small institutions, and then advocacy. So, it's really about the innovation. And then in order to replicate, you need to advocate to these other institutions. You need to show them, what's possible. And that includes your regulator as well. So working really closely with your regulator to get them comfortable with this, so that other institutions that they regulate may also be able to do this.
Yeah, great. Thank you. So sort of a quick follow-up question for you is scale always desirable? And what sort of pitfalls do you see as some of these mission-based organizations try to achieve greater scale? Like what could go wrong as they try to scale up?
And I'm going to start this one and then hand it off to Katrin, because she speaks about this very well. I think one of the key core challenges of mission-based finance, and one of the core challenges, is that there's already a pressure with money, with finance. There's such a strong pressure to make things sort of quick, to make them easy, to sort of standardize. And not every problem we want to solve can be standardized, right? So as things grow, as they get out of your hands, as they sort of move on to other institutions, as you try to scale up, you might find that actually by sort of simplifying something so that it can be done cost effectively, so that it can be, because institutions do need to, even if they're not making profit, they do need to break even, right? They need to be sustainable. And so you need to find ways to do things efficiently. You need to find ways to sort of scale in that way, that you might lose the connection to the purpose, and lose the connection to the things that sort of make it worthwhile, right? And so I would say that's one of the big risks, is that it loses the context that's needed, and it sort of loses we find that for a lot of our lending, we've seen this in a lot of the institutions, is you need to spend a lot of time with the borrowers. You need to spend a lot of time understanding whether it's a specific loan, or if you're trying to do sort of a bigger system innovation like Bank, like that's a lot of time and investment with each individual stakeholder, with each individual borrower. And if you're not doing that, then the question becomes, does this replicate? What does it look like when it replicates? Is it having the intended impact? Katrin, I don't know if you want to sort of build on that.
Yeah, I mean, it also has to do with the nature of money, So what is money? Money is only valuable because we all believe in it. And the question is, do financial institutions have a specific responsibility in our society because they have the permission to deal with, money? And the second thing I would like to say is, I think there is also a paradigm shift that's happening. So since we've started working in this field, the perception of the role of banks and the financial institutions in society has completely shifted. And I'm, not saying this is enough, but look at Deutsche Bank this summer, getting raided by the German police because of greenwashing. I would not have imagined something like that 5 or 6 years ago. So although I think our biggest challenge in this impact world is really to understand what is impact, I think that a lot has changed.
Okay, great, thanks. So let me follow up with that, with you, Katrin. As I was reading the book, what really sort of caught my attention was you really, but you really talk about taking a system-wide perspective. How does, can you talk a little bit more about that? Like, what do you think is the value in bringing a sort of a system, sort of a lens to this instead of a much more sort of a linear, or sort of a more traditional approach to thinking about impact and so on?
I mean, we are confronted with system breakdowns, the climate catastrophe, the divides. So our systems have flaws. So we need to take a system perspective. And before the financial crisis of 07 or 08, I felt in academia we weren't even talking about the overall system. You immediately got this reaction, oh, if you're not up for this, you're a socialist. But I think it's more about advancing our system. And I think we see something happening that Lillian and I in our discussion sometimes call the end of the neutrality paradigm, where this assumptions that businesses stay neutral is no longer true. So businesses have to take responsibility for the action. I don't know, Lily, if you want to.
Yeah, so just to sort of build on that, I think what we're saying about the neutrality paradigm is exactly what she was just saying. So, I think there has been a stance in the past, or an sort of a assumption or an understanding that, oh, we're just, we're contributing to society. We're by sort of building our bottom line, essentially. That is the value that we're creating. And I think more and more folks are saying and sort of understanding that no, every action you take has an impact, a downstream impact that you need to be held accountable for. So you can no longer have that stance of, our best value to society is sort of supporting our bottom line. It really is this sort of question of, how do you do that? Right? What are the ways in which you do that? What are the downstream impacts? And that ultimately that, that company, that business, that organization is responsible for those. And so, that sense of, oh, we're just neutral players in this. No, there are no neutral players. There are folks who are sort of doing things in a way that will create a more sustainable society or a more just society. And there are folks who are doing things in a way that are not, right? And obviously there is a spectrum along that. It's not a binary, but I would say the understanding that we're not neutral is sort of a new development.
Mm-hmm. Yeah, great. That's really interesting. One of the key sort of buzzwords, happening or that I've been hearing at the COP is this notion of integrity, and the importance of, particularly when we look at commitments that non-state actors have been making, whether it's in terms of net zero pledges and so on, right? This very important requirement for there to be integrity in the system. Can you expand on how you think of integrity with mission-based finance, and sort of, how do these organizations stay true, to that mission, that sense of purpose, and I know you have a whole chapter that you described sort of the three basic, sort of pillars, I think. But could you talk a little more about like how do these organizations really stay true to their mandates, their mission?
Yeah, I'm happy to chime in here. So maybe just to start off with, I'm sometimes a little suspicious of using words like integrity. They point at, this is a moral question of morality, and I think it's a question of rationality. So I refuse to accept that standard economics is rational and this form of economics is moral. I think this form of economics is rational. And so what we found is that if you shift away from the single purpose of profitability, you suddenly you open up this huge box of, oh, now I have to make a decision and I have to stand behind my decision. And some of our interviewees said, oh, when I worked in a traditional bank, in a way, it was much easier, you know. At the end of the year, I had a number and I filled this number or I didn't. So now I'm in an impact-focused organization, and now I have to talk about, why did I do this? You know, how did I assess the situation? Did I explore the background on this? So it takes a new way of operating a business. And we found, we call that 3 anchors. So if, you know, this one number, profit, has like this magic pull to be an easy solution for all the decisions you are making. So if you want to balance this with the impact that you are aiming to create, you need to anchor this idea across the organization. And it starts with the governance structure, the ownership of the organization. It continues with it really needs to be carried by the leadership, and it also needs to be implemented in the organization by the way you organize processes. So for example, a loan process. So, you know, the financial assessment is usually easy, but the impact assessment takes its own way. So you need to organize your organization in a way that your team can, you know, dive into this process. And just as a fun aside, one of the banks that we work with, Banca Etica, is a membership bank, and they train their members to be part of this assessment process. So you need to innovate the organization for how to operate that way. Lily, you want to?
Yeah, I'll just say, you know, I think the sort of standard policies and practices in institutions that are focused solely on profit often don't translate very well. And so, like Katrin was saying, there really is a need at every level, at sort of every step of the way, to think about, how do we frame this in a way that supports this policy in a way that supports the mission that we're trying to achieve. Because you can sort of hold the mission, you can have a good intention, but, you know, there's, you know, you need to build structures around it as well. So I would say a good, like a sort of an easy example is, you know, a lot of lenders are incentivized through sort of bonuses and commission to hit certain targets. Well, if you are, you know, in a mission-driven institution, if you're in a just banking institution and you're saying, okay, you know, half of your pay is dependent on, you know, getting 50 loans this quarter, you know, how are you making those loans? Are you doing it the way that, are you sort of taking the time with each borrower? Are you sort of doing the analysis in the way that, you know, the institution wants you to, and that it is needed to be done in order to do this the right way? So I think you need to think then in that institution, okay, how do we incentivize people? How do we sort of build a culture of doing this? How do we sort of, you know, when the sort of traditional incentive structures aren't available to you, you need to think of other ways. And that's been, I think, one of the core focuses, particularly of Katrin's work.
Mm-hmm. Yeah, no, that's great to hear. So in the book, there's, you know, lots of examples of you know, these very interesting cases. I was wondering if you could sort of talk a little more about you know, some of the most interesting sort of cases that, you know, come to mind for you, because there's a lot in there, and we've been sort of mostly talking a bit in the abstract terms, right? So I was wondering if both of you could share you know, any favorite examples that you have with this group.
Yeah, that's my favorite. So one of my personal favorite is Brak Bank in Bangladesh. So they work with what's called in the financial sector the missing middle. So banks don't have an interest in financing small and medium-sized businesses around the world. That's you know, an issue everywhere, because, as Lily said, you know, this drive towards standardization is really increasing profits for banks, and these loans in this area they are profitable, but less profitable. So they develop processes to provide loans for small and medium-sized businesses And I worked with some of these lenders. So when you go into the markets and you see these businesses, they often, when they start working with Bragg Bank, don't even have an account. They don't know how to read and write. And Bragg Bank has developed a technology. So these guys come in with a tablet and they actually, the loan officer checks out the business, so they go into the space, they go into the back room, they talk to the owner. So it's a very personalized process. And it is possible to provide loans for them. And then this is the area where job creation is really happening. Another of my favorite is Southern Bancorp in Mississippi and Arkansas. And I just had a call with them last week, and they started an initiative recognizing that physical health has to do with financial health. And they got a grant to start a collaboration with a health center for people who don't have sufficient health insurance. And when patients come in, the doctor also includes a question about financial health. And if there are issues around financial health, they invite the patient to go next door and talk to a banker. And I feel like this kind of innovation can only happen when you're really focused, or your interest is really in helping the community. Lily.
Yeah, so I just want to dive in a bit more, because my favorite example is the one that Katrin raised before about the member involvement in Banca Etica in Italy. I think, one of the things that we speak about in the book and is this sort of idea that ownership is a necessary but not sufficient condition to support mission-based finance and to support just banking. And so, we see a lot of cooperatives, but there are sort of different levels at which you can sort of choose to engage your membership and sort of, choose to activate them. And I would say Banca Etica does a sort of pretty incredible job of sort of activating their members. So they sort of have different tiers where they have members who are responsible for activating other members, who are responsible for the actual evaluation of the loans, where they, like Katrin was saying, they are trained sort of at a basic level in the sort of financial aspect, and they have evaluations, sort of I would say sort of a checklist that says, okay, these are the things that are important that the membership have identified as, being critical for a loan decision from a sort of social and impact perspective. And they individually, so these members spend time with the business owner, spend time with the company, even if they've gotten a loan in the past. I believe every 5 years there's a review process to say, should we continue lending? Should we renew this loan? Should we renew it after the end of the term? And if the member does not sign off on it, the loan does not go forward. And so that's the level to which the member owners of the institution are engaged. And I think that is just a really unique and interesting model that we've seen.
May I add one thought there?
Yeah.
So the payday lending example that I showed in the slides, it feels so logical. Why would you not take this immediately? And when they launched this product, this alternative to payday lending, it wasn't taken on by their members. And they thought, how could that be? So then instead of giving up, and it felt really irrational, why would a member who's paying 400% interest for a payday lender not using the bank's alternative? So they went out into the field and worked very closely with their members, and they realized that people were embarrassed and they didn't want to be seen by their neighbors or family. And so that's when they began developing this as an app so that people can do this at home. And I think this kind of following up and being really committed to finding solution is really a pattern that we've seen.
Yeah, that's really interesting. Can I ask you to reflect on sort of a bigger question before I go into the Q&A questions? What really motivated you to write this book? There's all these great examples that you're already sort of touching on, but could both of you talk about what really sort of drove this project, And yeah, why did you see the need for this particular book at this particular time? Lily, maybe, or Katrin, do you want to start?
Katrin, go ahead.
Okay, thanks. So we felt that, both of us back then were working at MIT. We felt that this type of banking is invisible, and we wanted to change that. So the mainstream idea around banking was, it's neutral, it's all money focused, it's just doing its thing. And we saw what's really needed, and we felt this needs to be visible. So that's why we first created this MOOC, and then based on the MOOC, we followed up with this book. And it's really about opening people's perspective on it is possible to create a different way, a different form of financial institution.
Exactly what she said. I have nothing to add.
Yeah, great. So let's dive into some of the questions that you're getting. The first one, and you've already alluded to this a little bit. This is from Carolina Madero. How do you measure impact?
Yes. So Carolina, this is a core challenge in this whole field. So since 2007, the whole impact investment movement has really exploded. It was launched by a summit that Rockefeller Foundation started. And everybody was like, wow, we can do good and we can make money. And then this movement realized, how do we know something is impactful or not? And it's actually not 100% possible. So Lily and I developed a system for, that we suggest, but in a way, what I believe is missing in this whole impact. So most banks would measure impact by creating some indicators and comparing past year to this year. And then the first question is, what do you base your indicators on? So I talked to one person who's responsible for impact in Bragg Bank, and he said, so I created this impact indicator measuring the amount of jobs we created by investing in these small and medium-sized businesses. And as Lily said earlier, what immediately was that now the loan officers would only give loans to the banks, to the businesses that created new jobs, to lift up this indicator. So what I found is the most innovative way to measure impact is what I've seen in GLS Bank in Germany. So they say we need to understand the impact from a system perspective. So if I measure the reduction in carbon emission from last year to this year, this number is actually not relevant at all. What we need to understand is how do my action pay towards a 1.5 Celsius degree goal. And what they've done with this idea is that they've gone through all the sectors that they are financing and conducted research. So what's needed to aim towards this goal? So they create this whole impact metrics that defines where they want to see themselves in the next 5 years and where they want to see their customers in the next 5 years. And they translate that back to the conversation they have with their customers so that the customer can see, where am I in this regard? And I find this is actually a really relevant way to understand impact. Lily?
Yeah, and I would just say, I think something that makes things very challenging for financial institutions is always the question of how much does our involvement sort of produce the impact, and in what way? If I give, a $500,000 loan, what proportion when you're sort of looking at metrics in a sort of more traditional sense. So I would say less in the sense that that Katrin is talking about, but like, for mission-based institutions or just banking institutions who are sort of just getting into this sort of impact measurement space, they are looking at metrics and they're saying, okay, how do we actually know how much our involvement creates this impact? And so I think that's always been a real challenge. It's a lot of questions and not necessarily a lot of answers. But yeah, it's a unique and challenging problem for these institutions.
Yeah, and the second variable is if you come up with some impact indicators, how relevant are they for your operation? So do people who are working as loan officers actually see them? So is there a learning process in the organization that takes these variables into account? So that's a whole other topic, but really important.
Yeah, great. Thank you. There's another question from Alyssa Zhao, and she is wondering about this difference between incremental change and disruptive change. And so she asks, do you believe that a change in the framework for value needs to come incrementally? Many major financial institutions talked about COVID being this disruptive force, but perhaps not much has changed. Do you think we're moving fast enough?
I mean, that's I think a concern we all have, and I don't have an answer to that. I don't think we are fast enough, but personally, I think we sit at the edge of a paradigm shift around how do we, who we are as society and how we organize our economic system. And as painful as the current situation is, I also see a whole movement of people who work in different ways. And that was also one of our inspirations to write this book. And I think what's emerging there as a new movement is not really visible yet. And our language describes our economic system still in these old terms. But I think something is really emerging here. And that's maybe also another reason why we wrote this book. I think we need a language for this new type of economics. And one language that Lillian and I experimented with is this idea of moving from an ecosystem economic system to an ecosystem economic system, which means that I'm still driven by my self-interest, which is a core idea of a market economy. But I basically expand my self-interest. So my self-interest includes my community, includes the planet. So I still act on this ego of creativity and but not for, from a different perspective, from a broader perspective. And I think this shift is happening right now. And we are not able to describe this yet, but I think this is a glimpse into, I think, where we are heading.
Yeah, great. So the next up is a question from Yan Wang, who is a senior researcher here at the GDP Center, and she wants to ask you about the role of the private sector in helping to mobilize finance for climate change. And she notes how at COP27, many officials from the global south have complained that developed countries have not implemented the promise of investing 100 billion in green sectors in the south. And how do you measure it? What are the incentives? And how do you reconsider the risks involved in the situation of debt distress? How do you incentivize them to invest in Africa, for example? So any thoughts from Katrin or Lily?
Yeah, I'm happy to go first. Lily, interrupt me. I heard only one. So the question is, what's the role of politics here? And I heard only one speech by Obama after he had just left office, and he said, "Politicians don't lead; they follow." And if that's the case, then the question, and he has been the most powerful man on earth for 8 years. So if that's his conclusion, then the question is, where does change come from? And if politicians are not leading, but they're following, who are they following? And I think we are underestimating the power of civil society. And what is I see happening right now is a focus on, through social media, on dividing our society. And the way we organize our financial system, our economic system, the way politicians react is a reflection of what they see in civil society. So for me personally, the answer to your question of how do we force politicians or the rich countries to do what's right is that we need to create spaces in society where these voices can be heard. So the founder of GLS Bank in Germany said, and that really inspired me a lot, we can only overcome our fear of the future by creating a vision of the future we want. And where are the spaces in our society where we can articulate this vision, where we want to go? And with a group of folks here at MIT, at the Presencing Institute, where I'm also working, we created a social infrastructure where we invite change makers all over the world to meet each other and to prototype new ideas. So over the past 8 years, we had over 200,000 people using this infrastructure. And in spring of each year, we have around 200, 300 teams who then take these ideas and transform them into change processes. So I think for those to force those politicians to take the step, we need more civil discussion and dialogue, and we need to take these spaces seriously. And especially, I think, as universities, we need to create these spaces. Lily.
Yeah, I mean, maybe the only thing I would add to that, sort of from a mechanism perspective, and this goes back to what we were sort of talking about before, I think, if let's say we're just talking right now about just banking institutions, we're just approaching this question from the financing perspective. I think, the types of banks and financial institutions that we speak about in this book are great testing grounds because they are much more responsive, I think, to civil society and to sort of, being at the cutting edge and being at the leading edge of these movements. And they act as sort of testing grounds, like we talked about, sort of, proving risk, proving how process, like how can this be done? What can it look like? And then using that to sort of hold up to these larger institutions who need to also be investing and moving more money than these institutions could ever dream of into this, like using that as sort of the prototype essentially for bigger investment, I think is really key in a lot of different sectors. I mean, we see it both not only in sustainability, but also in sort of, the anti-redlining movements in the US. Like, how do you move capital in big ways into communities that have been sort of historically disinvested? So.
Mm-hmm. Yeah, great, thanks. Just a reminder to those of you who have tuned in to please continue asking questions, and we'll sort of read them out. So one question that I think is sort of interesting, this is from Kursat Kini, and the question is about how the Fed's rate hikes could affect the innovation capacity of financial institutions. And this is sort of seems to get at what you also talk about in the book, right? About the need for these institutions to operate in sort of a more mainstream context, right? So maybe you could, talk to us a bit about, what allows these institutions to be disruptive, right? And how does that broader sort of mainstream context actually, shape how these institutions actually work. Who would like to take this?
I can take a first pass, and Katrin, you
Thanks.
can follow up. I think so. I currently work in an institution that's affected by these interest rate hikes. I mean, I think there's an interesting question, because we think about, how does it impact our ability to make loans, and it certainly is having the intended effect of cooling down the economy and sort of cooling down our ability to make loans, I think. And for particularly for us, like, affordability of financing is a huge issue that we try to address every day, right? And so this is making it more and more and more and more difficult to afford financing for folks who are already kind of at the margins, right, of being able to afford financing. And so I would say the way that it challenges innovation is that it makes it harder to sort of test what we're doing, right? One thing we rely on is, so we let's say, if we're speaking specifically about like lending innovation, right? We have an idea, we've worked with community partners. They say, we need this. We say, okay, how can we build this? What's possible? We build this product, right? We build this great thing that looks great on paper, sort of like Katrin was saying about the fair and fast loan. And then we rely on being able to actually put it out there and test it and get feedback from the market and get feedback from our members and the people who are borrowing from us and saying, oh, this works, this doesn't, all of that just becomes much more difficult as interest rates rise. So from a practical perspective, I would say that's the biggest barrier to sort of continuing innovation. On the other hand, like, it is moments of challenge, I think, that drive innovation. So I think, I would say at a larger scale, right? So coming out of the Great Recession, there was, a ton of opportunity for just sort of CDFIs in particular, which is sort of the space that I'm in right now, and then sort of where my head is at. Like, there was a ton of opportunities to step into the aftermath and into the destruction and say, okay, how can we be useful? What kind of change can we drive, and how can we build a stronger system moving forward so that this doesn't happen again? So it's also those moments of disruption that sort of spark, I think, systemic innovation, and gives the smaller players sometimes a chance to actually step into the system and have a loud voice and speak with authority and say, this is how we could move forward, and this is how we can change things. And I think, the aftermath of the housing crisis was a moment where that happened, where CDFIs really stepped into that space and worked with the federal government to sort of set standards moving forward. So, Katrin, I don't know if you want to build on that.
Maybe just adding one sentence. I think what is often a challenge is that the financial sector is just considered as one unity. And it's very diverse. And I think we need to better understand the diversity. And depending on what type of financial institutions you're working with, I think regulator really need to adjust this more and not put this all into one bucket. And the amazing work that Lily is doing also really points at that being able to access a loan is almost like a human right. It's very difficult to survive in this in this economic system we are right now without this tool. And so one of the CEOs we've worked with said the first thing that a mentor of him told him when he started in a bank was, a loan can rescue a life and a loan can destroy a life. And I feel this really points at that this cannot be standardized, and work like Lily's institution is doing is really essential.
Great. So if I can ask, one final sort of rapid fire question, just to summarize this very, very quickly. What do you see as sort of one major limitation, right, of finance as a tool for change, and how do you think just banking institutions can, overcome that? If I can maybe start with Katrin first and then come to you, Lily, and then we'll wrap up.
This form of banking requires a different way of thinking around the economy, or around finance. And I think this kind of thinking has to really settle also in society overall. And so I think there's a limitation in how well this type of finance is understood. And looking into the organizations we work with, there is definitely a scaling challenge.
Yeah, I would say, sort of from the perspective of a lender, there's only so much you can do in terms of sort of new products or product innovation. At the end of the day, there's the inputs that are coming into your underwriting criteria, right? And to the process that you've set up and to the loan that you've set up. And if the inputs aren't penciling, it can be not only, it's risky for what we said, a loan can support a life and a loan can destroy a life, right? You don't want to create too much risk for the borrower. And so I think, that is where this sort of level 3 and level 4 innovation comes in, levels of intervention where, I think you sort of overcome that sort of obstacle by engaging with, okay, so the folks coming to us, their incomes aren't high enough. Well, who are we working with to support living wage? Who are we working with to support all these other pieces, to cancel student debt, to sort of do all these other things so that when people do come to us, we can actually support them, right? We can sort of work with them to get that loan. So I think there's all these other pieces in the system that need to be, all these other points of intervention that financial institutions need to engage in as sort of part of a cohesive whole, and not just say, oh, we can't, this is as far as we can go on the lending product, right? It's like, no, you can engage all these other stakeholders as well to sort of push the system.
Mm-hmm. Great, thank you. We're like running right up against the hour. So very sincere thank you to you both for sharing your thoughts with us today. And to everybody who has joined this discussion. This talk has been recorded on YouTube, and we will be sharing the link in the chat. I would also like to welcome you to the final, to join the final installment of the Fall 2022 GEGI Book Talk series on December 1st with Zainab Usman on economic diversification in Nigeria. If you have registered for this webinar, you are automatically registered for that one as well. And to receive updates on our publications and events, you can subscribe to receive updates from our Global Economic Governance Initiative that you will see in the chat. Thank you